This is Victor Antonio with another value-centric sales moment. Today I want to talk about discounting. Back in the 1980s, Tom Reilly wrote a book called Value-Added Selling Techniques that highlighted not only an example of how profitability impacts your sales, but how it also impacts a company negatively. So what I want to do is walk through an example because it's very insightful and very, very educational in terms of understanding the impact of discounting on yourself and the company. So let's walk through it slowly. Let's assume that your sales volume is 500,000. Okay, that's your sales volume. Your direct cost for the company to manufacture that product, let's say, is 250,000, which means that the gross profit is obviously 250,000, this minus that. Now, let's assume also that the variable cost and the fixed costs are both 70,000 and 150,000. So if I take out those expenses, my net profitability now is $30,000. With me so far? No problem. Now let's assume for a moment that you start discounting your product as a salesperson by 15%, 1-5. Let's look at this column now. 500,000, let's say you discounted your product, so now top line revenue is 425,000. Direct costs stay the same, but now your profitability is $175,000. Let's keep variable costs and fixed costs the same, and look what happens. Look at the dramatic impact of that. A $45,000 loss for the company with a simple discounting of 15%. In other words, discounting 15% caused the company, all variables assume the same, to lose $45,000. That's the impact of discounting. But that's what companies hate, right? Discounting. They don't like discounting because it impacts them negatively. But how does that impact you, the salesperson? What does that do to you? When you discount, you have to sell more. So let's look at the third column. In order for the company, not yourself, the company to get back to 30,000, you would have to increase your sales to approximately $610,000. And because the company's now manufacturing more, selling more, stuff's going to the factory more, guess what? Costs go up to $360,000. So in other words, if we do this, if we believe this ratio, that sales go up and costs go up in this ratio, you'd have to sell $610,000 more, which is $110,000 more than the $500,000 if you had not discounted. What does this mean? If you take the expenses, you still get your 30%, $30,000 profit. But what does that mean to you as a salesperson when you discount? When you discount, if you had to sell $500,000 because you discounted, now you have to go back and now sell $610,000, which means to you, the salesperson, you have to increase your sales by basically 44% just to get back to the company have its own profitability. In other words, for the company to be profitable again, you'd have to sell, or the company would have to sell 44% more. And when you look at these numbers, you realize the impact that discounting has on a company's bottom line. So again, there's two mindsets in this world, right? You can have a value-centric mindset, which means let's sell the value and not discount as best we can. There's always a couple percentage points we're going to have to give up. That's understandable. That's real world. But if we have a discount mentality where we're just trying to win the business through discounting, this is going to be the impact to not only you, but also your company. I hope this helps clarify that having a discount mentality is not the right approach, but having a value-centric mentality is the right approach. This is Victor Antonio, one of the sales moment, reminding you, selling ain't hard when you know how. Take care.